We're absolutely swimming in a sea of financial data these days. Market returns, economic numbers, charts coming at us from every direction. But let's be honest, most of it is just noise. So the real question is, how do we cut through all that static to find the actual signal? How do we find the story that the numbers are trying to tell us? How do we take this chaotic flood of information and turn it into something clear, something that actually helps us understand potential rewards, and just as importantly, potential risks? Well, today, we're going to crack open the essential statistical toolkit that every single analyst uses to find meaning in the markets. And this is what we're up against. This is our starting point. Pure chaos, right? It's just a wall of raw data. You could stare at this all day, and you're not going to find a single useful insight. It's overwhelming. So to make any sense of that chaotic wall of numbers, our very first job is to bring some order to it. And we do that by organizing the data into something called a frequency distribution. This is probably the most fundamental tool we have. And it's a really powerful idea. Instead of getting lost looking at every single data point, we just group them into logical buckets. Seriously, think of it like sorting a giant, messy pile of coins. You put the pennies in one jar, the nickels in another, the dimes in a third, and all of a sudden, you've got structure. You've got order. And here's what that looks like in action. We've taken all those decades of S&P 500 data, and we've simply counted how many years the return fell into a specific range. So for example, returns landed somewhere between -10 and -8% in 7 different years. Instantly, you can see a pattern starting to emerge from all that noise. The next step is even more intuitive, which is great. We turn that table into a picture, what we call a histogram. This bar chart literally creates a skyline of the returns. And the beauty of this is you don't even have to read the numbers anymore. You can just see where the data tends to cluster. See that tallest bar? That's where the most common outcomes live. Okay, so now that we've given our data some shape, the next logical question is, well, where is its center of gravity? We need to find a single number that can represent a typical return for this entire data set. What we're talking about here is a concept called central tendency. In the world of finance, this is really our first shot at quantifying the reward. Anytime you ask a question like, so what kind of return can I typically expect from this thing? What you're really asking for is a measure of its central tendency. Now, the most common measure, the one we all learned back in school, is the arithmetic mean. You know it as the average. You just add up all the returns and divide by how many there are. Super simple, super straightforward. And it has the benefit of using every single piece of data. But, and this is a big but, the mean has a critical weakness. Because it includes every single piece of data, it can get dragged way off course by just one extreme value, what we call an outlier. And when that happens, it can give us a really misleading picture of what's actually typical. Let's see this in the real world. Here's a portfolio of 7 stocks. Take a look at their price-to-earnings or PE ratios. Most of them are hanging out in the teens or 20s. And then you've got Click Technologies, way out there at over 200. That's a serious outlier. So what happens if we calculate the simple average, the mean of this group? We get 42.49. Now, just look back at that list for a second. Does 42 feel like a typical PE for this portfolio? Not at all. It's actually higher than 6 of the 7 stocks. That one outlier has completely distorted the average. This is exactly where our second tool, the median, comes in to save the day. The median is simple. You just line up all the PE ratios from smallest to largest, and you pick the one in the dead center. That's it. In this case, it's 13.94. And notice something important. That crazy high number from Click Technologies, it has absolutely zero effect on the median. So you have to ask yourself, which number gives you a better feel for this portfolio? In situations like this, where you have these huge outliers, the median almost always paints a more accurate, more representative picture of the data's true center. It's a much more reliable guide. Okay, now for another distinction that is absolutely critical for any investor. Let's say your investment goes up 100% in year 1. Great. But then in year 2, it drops by 50%. If you calculate the arithmetic mean of those returns, a plus 100 and minus 50, you get a positive 25% average. But what actually happened to your money? You're right back where you started. Your real compound growth was 0. And this right here is the whole point. The arithmetic mean tells you the average of each individual year's performance, but the geometric mean, that tells you the actual compound rate of return you experienced over the entire period. It's the number that reflects what really happened to your account balance. So we've figured out how to measure the typical reward, but that's only half the story, isn't it? Now we've got to talk about risk. And a great way to think about risk is as the wobble of your returns, how much they bounce around that center point. To really get this, let's compare two different investments. Here's investment A. It delivers an average return of 5%, but just look at the journey to get there. It's a complete roller coaster. Big swings up, big swings down. And now here's investment B. Guess what? It also has the exact same 5% average return. But look at the ride this time. It is so much smoother. The returns are all tightly clustered right around that average. You really don't need a PhD in finance to answer this one, do you? Investment A clearly feels way riskier. That potential for huge swings, for big gains but also big losses, is much, much greater. Even though they ended up in the same place on average, the experience of holding them would be wildly different. Well, that wobble, that gut feeling of risk, analysts have a formal name for it: dispersion. It's simply a measure of the variability around that central point. In finance, this is how we actually quantify risk. We put a hard number on just how wild or how smooth the ride is likely to be. All right, let's bring this all together. We've gone on quite a journey here, starting from a chaotic mess of numbers and ending up with a much, much clearer understanding of an investment's true character. We've seen the whole process play out. First, you organize the noise with a frequency distribution. Then you visualize its shape with a histogram. Next, you find the center, your measure of reward, using the right tool, whether that's the mean or the median. And finally, you measure the risk by quantifying the dispersion around that center. You see, it's a logical path that takes you from total chaos to real clarity. These concepts, they really are the foundation of all quantitative analysis. They give us the power to describe, to compare, and ultimately to make better, more informed decisions. The data is out there waiting for you. And now you have the basic toolkit to go beyond the noise and find the real stories hidden deep inside the numbers.